Federal Reserve is going to put interest rates at a place where it's going to break substantial pieces of the economy, and then they're going to rescue select members of this economy. It's not capitalism, it's state-controlled capitalism. I don't think it's a conspiracy. I think it's very obvious. The problems that are emerging right now, commercial real estate, you're seeing all these things break down. Some of the weaker banks are breaking down. And I think we have more to go. And so my message to people is something's going to break. Don't let it be you.
We're entering an era of state-controlled capitalism, no longer free markets, says E.B. Tucker, author of The Tucker Letter. And these are the consequences for the everyday consumer. Welcome to my show, E.B. Important messages you have for us today. Thank you for being here.
Thanks for having me. And I'm so excited about your show. And I appreciate you asking me to be one of the first guests to come on. It's an honor.
Well, it's an honor to host you as always, E.B. I've known you for a while. You're an excellent analyst. Now, we're going to be talking about your analysis today. Give us a summary of one of your first few reports that you've done on the Tucker Letter, and we'll set the stage that way.
Well, here's the problem. I had a fairly substantial career in financial publishing. I wrote lots of letters. A lot of people have known me through that for many, many years. And as people know, in 2020, I gave that up. And part of the reason I gave it up was that, I started hearing from people that the message from me to them was cluttered by advertising and by tacky marketing. And it was distorting the purpose of reading my work, which was for me to tell you how I see things right now and to help people navigate. So I gave that career up. I wrote a book. We've been friends through that whole thing. So I've been on your show many times. But I started hearing from people, look, we need help now. We need to know what's happening. We need to know what's going on. As you say, it's not, do this, do that. That's not really the deal. The deal is, hey, guys, I'm at the desk. This is what I see going on. This is what I'm doing about it. So in the Tucker Letter, which you can find at ebtucker.com, you have a direct message from me. I mean, people can read this, they can catch up with what we've been doing, and they can see that I'm actually showing the portfolio that I'm managing on behalf of a trust where I'm the trustee. And it's very important as trustee to navigate these types of scenarios. Let's today talk about, to me, this has been really, really clear what's happening. The Federal Reserve is going to put interest rates at a place where it's going to break substantial pieces of the economy, and then they're going to rescue select members of this economy. It's not capitalism, it's state-controlled capitalism. I don't think it's a conspiracy. I think it's very obvious. The problems that are emerging right now, commercial real estate, you're seeing all these things break down. Some of the weaker banks are breaking down. And I think we have more to go. And so my message to people is something's going to break. Don't let it be you. And it's not that hard to navigate this stuff once you're sober about the setup. And it's important for us to see what we're dealing with here. I've got a chart in the issue that came out today. By the way, issues come out every other Thursday at 9 a.m. The issue that came out today shows what these guys have done. I think the rates might actually be finished going up. I don't know if we need to go up much more, but the whole system is rattling, right? It's rattling, and you can feel it with Credit Suisse. You can feel it with Americanas going bust in Brazil with an accounting situation. You can feel it with Greensill. If you remember all these things, Archegos, all the FTX, all the cryptos, make a list of all these things that have rattled. They're the consequences of 20 years of free money. And so that's what's under pressure.
Ford versus Ferrari. Have you seen that movie, Ford versus Ferrari?
Yes.
All right, well, there's a scene at the end where Ken Miles is racing down, I believe, the last lap. And he's racing his opponent, the Ferrari driver, and they're neck to neck. And Ken knows that at a certain point, the engine will just stall and break. And so he's pushing his opponent to rev up to, I think, 8,000 RPM or something like that. And that reminds me of your story about the Fed, because past a certain point, the Fed's at 7,000 RPM right now. You're saying past this point, the economy is going to break. The engine's going to break.
Well, they've already started expanding the balance sheet, by the way. I have a chart in there today where when they had the SVB situation, they actually pumped money into the system. So the balance sheet only came down for just a teeny tiny bit. So it's not going to be this scenario where you're dealing with this forever. That's why the rates had to go straight up, David. That's why the chart is straight vertical, because if they did this over a long time, it would be an avalanche. straight vertical puts everybody into freeze mode. We're in stall. Ever go to a roller coaster? You go up at the top and they wait at the top and then give you a little fake out and then they drop you down. This is what we're doing. We're in this top of the roller coaster waiting and they're dangling us over the cliff. And then, all it takes is enough so we see the whites of people's eyes and then they come in with another rescue. That's the system that we're in.
Okay, but you also said that I think they're done raising, the Federal Reserve is done raising interest rates?
I think they're close to being done. I mean, if you notice the expectations on this Bloomberg behind me is quite handy. It has expectations have now matched the current rate level. I don't know that there's much purpose in going higher. Let me give you a real world example. Let's say that you have an apartment building in an urban city like New York City that's worth $100 million. And you've taken a loan on that 5 years ago. Now, most commercial loans are 5, 6, 7 years. And you took a loan on that building at, say, 3%. And now you have to re-up the loan next year, and the rates are 6%. So that building is underwater, and the lender is going to say, we can only loan you, 70 million instead of 90 million this time. And you got to come up with that 20 million and you don't have it. And so this is the situation that the whole economy's in. You don't put a 30-year mortgage on an apartment building. There's not really, it's very rare that there's such a thing. And we're facing this scenario. I'm looking at this stuff every day where the commercial lending market is frozen. And the whole system that we have today, it's so easy to understand. 20 years ago, the Fed decided we have to make money just a tiny bit cheaper at every turn. And that makes people feel rich. Okay. So you have a $200,000 house, you take a loan on it. 2 years later, you got to repair the pool. It's worth $210,000. You take a $5,000 equity line, you spend that money. You never really pay it back. 2 years later, it's worth $220,000. Oh, you're back with your head above water. Do you see how this goes? The whole system is like this. And that's why if the Fed keeps going, and the Fed crashes everything out, there's no system to control. Do you understand what I'm saying? The apartment building, if it gets foreclosed on, well, then all the other apartment buildings around it are now valued lower. You see, it's a tidal wave. And so my point is that that's why they had to go straight up in the air, is to make the whole thing rattle and shake out a few scenarios like an SVB, a Credit Suisse. There's going to be more. There's going to be more of these things. But people don't understand that we've only just seen a teeny tiny little reduction in all this free money. When they turn that corner, you're going to have to be invested properly because things are going to blow up. The Fed is going to lose credibility, and you've got to be ready for that. But it could be 3 months, it could be 3 weeks, it could be 6 months, but it's not going to be 3 years. Believe me.
So the Federal Reserve, let's assume they don't raise rates anymore. Let's assume the last one they had 2 weeks ago was the last one. The question is, how long they're going to maintain rates at elevated levels. And if that is enough to break the system that you're talking about, we'll get into that a little bit deeper. But if that's enough to break the system simply by not pivoting and reducing rates, what do you think?
It's possible because what is happening now, if you notice, is that the SVB account holders were a very privileged class of people. These are your tech founders, all these different people. And they exceeded the federal insurance deposit limits. And so what happened is the government steps in and backstops these people. So what you're seeing is selective capitalism. In real capitalism, the bank would have failed, the stockholders would have gotten zero, and most of the loans would have ended up being bought for distressed prices. But this is not capitalism. What this is this capitalism for some people. So that's state-controlled capitalism. So the Fed right now is trying to raise rates to create pain, to suck money back into the United States. I just came back last night from the UK. I was there for a board meeting. I'm all over the world. I'm telling you what the US is doing is putting serious pain on other parts of the world. There's a strategy to that. They have to create the dollar strength so they can run around the world and use the dollar as a weapon to have certain policy goals met. So that's what's happening right now. So they have to keep doing this, but they're going to create pain in the US. So the game plan is keep this strong rate regime going, fix pain in the US for certain people. Now, if you're an average person that was overextended and now you got to roll over your loan at 10%, or I don't know, try getting an auto loan. An auto loan, I'm not in the market for an auto loan, but an auto loan can be 10% now. People just can't afford that, right? So you're just, you're feeling the brunt of this. However, the Fed's goal is we'll protect strategically important groups while we ratchet up the strength of the dollar, giving us power on the world stage. You know all the reasons for that. That's the scenario that we're in. Now, in that scenario, does it sound like a good time to gamble? Absolutely not. there's about to be a huge brawl on the casino floor. It's not the time to gamble. Okay, it's the time to avoid being caught up in the brawl.
Okay, but EB, just to push back a little bit on the Fed bailing people out and making it state-controlled capitalism, I've heard the argument that SVB was bailed out partly because the Feds and the Treasury wanted to send a message that they would support banks and backstop any further run on the banks. That's supposed to provide confidence to investors and depositors, because if they didn't do that, it would be even worse. People would take their money out at an even faster pace, right?
Absolutely. No? So there's 17.5 trillion of bank deposits in the U.S. It's a lot of money. There's not 17.5 trillion of actual money. So if you don't maintain credibility in the system, then you have a huge problem, and then you have no system to control. Okay, so it's very interesting. The bank that took over SVB, I was actually born in the town that bank is headquartered in, and I've met the family that runs that bank, and it is some of the best people that you can ever do business with. It's really amazing to see that First Citizens Bank on the other side of the country from SVB. I mean, this is like tobacco farming, Eastern North Carolina people, extremely strong, extremely responsible, huge roots in the ground. And so the Fed obviously wanted to put that trouble into the hands of a strong organization. That's what they did. But to your point, you have to maintain credibility or the system doesn't work. That's the deal. You have to keep the facade strong. And so, yes, that was a $42 billion request for deposits out of 17.5, close to 18 trillion dollars. I mean, think about that. So the system survives on faith. Faith is the cornerstone of the United States system. Okay, not gold, not real assets, faith.
All right, so let's walk through your scenario. Suppose the Federal Reserve raises interest rates again, or even if current rate levels are enough to break the system, what breaks first? Walk us through this domino effect that's about to happen.
Well, I don't think there's necessarily a plan of what happens first. I want you to start thinking about zombie companies. Now, people at home should understand a zombie company does not generate enough positive cash flow to even pay the interest on its debt. And the zombie company became a zombie because it was able to borrow money at close to 0% levels, even though it had no profits, sometimes no sales, very little adequate infrastructure to survive a recession. A recession is what we used to have during capitalism. Now we have a sustained boom with the occasional brief panic. So what's going to happen is that when these zombie companies, for instance, Class B, Class C office real estate, that means not the beautiful brand new building, but the building that was built, many decades ago that somebody bought with a huge loan, hoping that it would go up in value and they could sell it, pay the loan off, and keep the difference, which is actually a smart move. When this loan has to be reworked and the coffee shop down below went out of business or closed or whatever, the office says 25% of people work from home, so we don't need as much space. The rents are down, the costs are up, the maintenance man needs a raise. The bank or the lender, which is usually a regional bank, which is why you're seeing all the regional banks hurt so much, says we can only give you 65% of the loan that we gave you before. One of these is fine. By the way, the Trump building and 40 Wall Street is going to face the same problem. I mean, this is like New York is basically underwater from a commercial real estate perspective at the moment. So I don't think rates need to go any higher. What happens now is time. It's like a stock chart. A stock chart can either correct by going down or correct over time by going sideways, because time is the same as falling on a stock chart. And so all we need is time. So you start getting into maturities of these loans, or companies that say now we have to re-up and we have loans that we took 3 years ago at 1%. We have to go back to the market, and the market wants to charge us 8%, and the sales are the same and the costs are up. We don't know what to do. Do you see how this plays out? So I think from the Fed's perspective, how long can we push this before? See, right now, nobody's complaining. When I meet with people, David, they say, come on, give us some stocks to buy that are going to go up. That's what they say to me. And I say, you guys, this is not the time to be doing that. This is the time to be bracing yourself so that you're not one of the ones that ends up with rubble on your head.
I, a lot of people in the comments of my new show have been saying, "Hey, David, give us some good news for once." I'm going to ask you that before we end the call, DB. I'm going to ask you for some good news. But let's finish off on this discussion because you brought up some very good points. If you were a zombie company, let's say if you were a CEO of a zombie company, first of all, two-part question, which sector would you likely be in right now? Which sectors contain the most zombie companies? And second, what would you do if you had to refinance at a much higher rate right now, keeping in mind that the debt, the interest expenses you had to pay, you're paying now are probably based on loans you locked in years ago at much lower rates, but now you've got to refinance either later this year or next year, and you're in deep trouble. Right? What do you do?
That's right. I would be in first of all, the sector probably would be high growth tech. That would probably be the sector because that was a sector that benefited tremendously. Like any idea got funding. If you think about the last 10 years, you say, I'm going to improve this industry. This is my idea, and you get, $100,000 in funding at a valuation of $1 million, and then you get $1 million, a valuation of 10 million. Remember all these stories. And then next thing you know, you have a $100 million company, but you've only raised like $3 million, right? So I don't think these businesses are worthless. I do not think that they're largely worthless. I think they're just worth less. There's a difference between being worth less and being worthless. I think that these businesses have got to be more realistic. And as they come back, they're going to come to investors like me who are going to say, I'm willing to invest in this business. I'm not quite willing to pay the multiple that you've had before. That is called being realistic. And David, everyone that knows me knows that I'm a psychology buff, with philosophy. And I'm telling you that it is very difficult for people to admit that their company is worth less than they think in their mind. Okay. Everybody has an idea of what it's worth. And when you suggest otherwise, it's very difficult for them to agree with you. In fact, at first they tell you that you don't know what you're talking about. Second, they tell you that you're wrong. They'll find someone else. Then they exhaust all their effort finding someone else. And then they finally can't come back to you because they're too embarrassed. And this is how the cycle goes. Now, the opposite is true at the bottom. Okay. The opposite is true at the bottom. In stocks, when you've got a stock you can't give away and the industry is down 90%, now you're in a place where you can pick through and find winners. If you remember, I bought a bunch of real estate in 2009 and 10 in the US. Nobody was buying real estate. All these jabronis with, used Maseratis and, loans and hard money lenders following them around. These guys they didn't exist. They were living with their mom. There was nobody buying houses. Nobody. Okay. So I was the only one. In fact, realtors wouldn't even show me the house. Now, I was paying $10 a square foot. People can't believe it, but it's true. I have I sold all these things last year. I have a huge tax bill coming up in 2 weeks. The point is that psychology governs these markets, okay? Philosophy should govern your approach to these markets. You've got to understand these things. And these companies are not willing to admit that the previous value where they raised money is too high. So that process takes time, and you cannot talk somebody out of delusion. If you encounter somebody that's delusional, you have to let them work it out themselves. And so that's going to happen very slowly over the next year. And so we want to sit on the sidelines. We don't want to tell them they're delusional because nobody takes that well. We want to sit back and wait. And that's why you've got to be patient right now, because if you buy the wrong asset at the moment, you're going to be part of that adjustment period. It's very painful.
You said something very important earlier. You said that commercial lending is all but frozen. Tell us about the ripple effects of commercial lending being frozen. How does that impact the everyday guy?
Huge. So people need to understand, my grandfather was in banking. That's how I know the people that are buying Silicon Valley Bank. And regional banks are always going to be a part of our system. They're never going to, they might turn into utilities of sorts, but they're always going to be part of our system because these are the key lenders for big projects. The national banks like JP Morgan or something. JP Morgan is not going to do a great job of lending in Greenville, South Carolina to a property developer. They can't possibly know all those markets. A community bank or a regional bank with a presence in the town is the big lender. And so this is typically where the process begins for financing a lot of development-oriented activity. And so these banks right now are having a huge problem. They're having to pay higher rates on savings. They're having to pay higher rates from borrowing money from the Fed. They've bought fixed rate long-term debt instruments, some of them have, which are tremendously underwater, as rates go up. So they're having a capitalization issue. And at the same time, to make matters worse, depositors are pulling money out of the bank for two reasons. Number one, out of fear, which is a bit crazy because where are you going to go? Number two is because expenses are up and people haven't quite realized that they're the subjects of inflation. And so they're having to spend a little bit more and a little bit more. They have a little bit of savings, whatever. They're running through this extra money. And so this is about the worst scenario possible for banks. The bank stocks are going to go down more. I think bank stocks actually will end up being, at some point a deal because they can only go down so much. I mean, the businesses are not worthless because they're a fundamental piece of the economy. They're unlikely. They're likely to consolidate. There might be some that fail into each other, but they're not likely to go away. We might have less banks after this is over, but we're not going to have no banks. And so this is where the pain point is. If you're an investor on the sidelines, this is what you want to watch, right? I mean, it's not really. I have the annual report here on my desk for one of the banks where I'm a stockholder. And I'm reading this thing and I'm deciding, what do I want to do? I feel like I understand what's ahead for them, and the next few months are going to be nasty. But there will be a turning point, and that turning point probably becomes a very interesting time to have exposure. In ebtucker.com, in the Tucker letter, we will probably take a look at banks at some point once the full brunt of this has been felt.
Yeah, so I think that's the key question people want to understand is, what is this turning point? You mentioned being patient several times. Well, what exactly are we waiting for? Tell us about this turning point.
Well, so you want to see the whites of their eyes. I mean, that's the deal. I mean, when you're at maximum negativity, when maximum fear, when you're at that point, it's probably time to take action, because what happens is at the top, people are not afraid enough. At the bottom, they're too afraid. It's very difficult to once you see things this way, it becomes quite lonely as well, because you're going against the society. But people are not afraid. I mean, look, I'm overseas all the time. I'm in the major cities. You can't get a Rolex still. You can't get. I mean, it's crazy. I mean, the restaurants are full. It's nuts. People are not. They know something's going on, and they know that the something going on is not good for them. But they're not in all-out panic mode. That's why we have more time to go. When you see them in panic mode, like for instance, in 2010, people were negative on the stock market, but that was a great time to buy stocks. That was right on the cusp of Bernanke telling everyone he was going to print money and as much money as necessary to make stocks and house prices go up. You see what I'm saying? So right now, the general sentiment is people know something's wrong, but they're not in panic mode.
Aren't you concerned that if this time around, let's say you have maximum fear, in your words, wouldn't that imply that the system has already broken beyond repair and that there's no hope for investors at all?
Well, betting against the system is not. I was having dinner in London with some guys, and I was saying, look, you got to realize something. The system, betting against it has not been a wise bet. The ability to think about it. 2 weeks ago, everybody thought their bank was going to fail. Now everybody's pretty much forgotten about that. So the ability for the U.S. system to maintain credibility, even though it does appear to have big problems, the ability to maintain that has been pretty remarkable. And so I think it's very hard to bet on collapse of the world's superpower in the short run. And actually, I don't think it's a very good bet because that's a scenario that doesn't work out well for people. I think what's more likely is that if you fast forward 5 years, that the nominal value of assets and the cost of things you need is much higher. I think that what people miss about the last 20 years is they actually have not become wealthier. They just have more money. And so what's going to happen over the next few years, if you play it right, is that you've got to ride that wave. The cost of things is going up. Your asset values are going to go up. Your real wealth might or might not go up depending on how you position yourself. But I think that people need to see that the price printed on something is probably going to go higher. And in the short run, there's going to be maybe a panic event. And that panic event is somewhat brief. And you have to endure that panic event. I've got a chart in today's issue of the Tucker letter that shows some past panic events. And what you got to see is these are not recessions. These are just continuous booms with the occasional train wreck. And I think we need to be ready for more of that. That's what's coming. And you don't want to get caught up in that. You don't want to be strung out where you get frozen out. If you got frozen out of the COVID crash, you really missed out. I mean, that was a bad situation. And so if you can see things from that perspective, I think you're better positioned.
Okay, so tell us about some of these panic events that are in this chart. Past panic events.
Yeah. So I mean, if you go back, so I've been doing this for a long time, and we used to study leading indicators and recessions, and we would go out and do. We would go to stores, and we would like survey the people that worked there, and we were always trying to figure out casinos. We would always visit casinos and see if people were gambling more or less. And this was a way that we predicted recessions in advance, and there were certain stocks that benefited. But that's during capitalism. So now when we have state-controlled capitalism, it looks like capitalism. People believe that it's capitalism. But what it is that it's these brief panics where things get very, very tense for a very short period of time. And then the regulators do unexpected things that would never happen in a free market. For instance, during COVID, if you recall, the market went down about 35%, 33%, something like that in 3 weeks. So the U.S. market lost 13 trillion of value, and I have a chart of this in the Tucker letter, so people can see it. It went down by about 13 trillion in 3 weeks, 30%. And then it turned around because the Fed announced that they would buy junk bonds in the market. The junk bonds are bonds issued by companies that can't really afford to repay them if there's any trouble. And so the Fed bought those at full price. And what happened is that reversed the market and shot it back up 35% in about 10 weeks. So if you missed that, you were in big trouble. That was a huge panic event. And so that's not something that happens in capitalism, because in capitalism, investors would have to buy the junk bonds. And investors say the junk bonds are worth 50 cents on the dollar because the companies are risky. But the Fed said they're worth 100 cents on the dollar. So that changes the market's behavior. So right now, the market's starting to expect the Fed to be done with rates. If they're going to go higher, that'll hit the market really hard. If they're done, that'll send the market a different way. So this is state-controlled capitalism. This is not investors making these moves. If investors are making these moves, then things work out a bit differently.
You said earlier that you're expecting nominal prices to go back up. Are you assuming inflation is going to return, or am I misquoting you?
Yeah, inflation's here. I mean, it's here right now. I mean, the thing is that people are distracted at the moment. They do not really understand.
Is it going to go higher though? Is inflation going to go much higher after this recovery?
It's pretty high, right? I mean, you're having numbers come out that are 6%, this range, but I'm experiencing quite a bit more inflation. I mean, I have lots of people working for me and doing all these things, and I'm experiencing higher than 6% inflation. I'm seeing it in insurance. I'm seeing it in fuel, building materials, food, labor, software, every single point on the curve. I'm seeing inflation much higher than 6%. And I don't think any of these people, David, are going to lower prices. I mean, believe me, like my gardener is not going to lower the price. Okay, we just are having this discussion right now. There needs to be a wage increase. I'm going to give the wage increase. I'm happy to do it. But I doubt that a year from now we're going to have a wage decrease. I don't think so. So what I'm saying to you is these costs are here to stay, and I don't think people have wrapped their head around that yet. I think they're running through the couch cushions and going, using up extra saved money, getting by. They're making in the current issue of the Tucker letter, we talk about the company that we're recommending is showing how certain sector of the product that they provide is seeing stability. Other sectors are seeing down. It's very, very interesting. So we're quoting out of the annual report there. I think people are making adjustments to their purchasing decisions, and those adjustments help them get by.
Wages are sticky downwards. I mean, the biggest cost for most consumers. Let's analyze this: housing, car payments. Let's say you're a homeowner, you got to pay your mortgage. Everyone's wondering then, when are my mortgage
much higher
going to go back down? You're going to go up higher before they go back down?
Well, I mean, I think if they even stay here, they're unaffordable for people. And people haven't yet come to the realization that if you're buying a starter house, let's say a starter house is, $300,000 to $600,000, depending on where you live. If you're buying that starter house at 3% mortgage or 7% mortgage, that is a huge amount of money. I mean, that is over the life of the loan, that is a massive increase in money. And so what that means is that you probably can't afford that much. You have the prices to come down. And if the price comes down, then the comps come down, and then the neighborhood comes down a little bit. You see how this goes? There's a chain reaction. I don't know that mortgage rates need to go much higher. In Canada, they've created massive pain. Massive pain. You notice the Canadian central bank has stopped raising rates at the moment. And part of it is because Toronto will be underwater. I mean, most people have a variable loan there. In the US, they have fixed loans. I mean, it's so easy to see this. I mean, there's people just can't carry on. Now, if their $1 million condo in Toronto is worth 900, what happens? I mean, that's a huge situation. That's people's biggest asset.
Okay, so historically, the Fed has kept rates elevated for about 8 months to 12 months before lowering them. Do you think
shorter now?
Short amount, yes. Do you think the Fed funds rate will come back down next year? And if so, mortgage rates, will they come back down next year?
Well, I don't know how much they'll come down. What I think people need to watch for is this is a dynamic situation, not static. I think people need to watch for when the pain is at a maximum place, and then what the Fed does next. Because this increase in the Fed balance sheet that happened with SVB, nobody's talking about this. I mean, I have it in the newsletter, but nobody's talking about it. So right now they're able to selectively increase their balance sheet to help certain people, and nobody notices. So how long can they do that? Maybe a little longer than you think. I mean, if average people are having trouble, but they're able to bail out connected people, that can go on for a little while. So I think people need to forget about going back to 3% or something. I mean, they have to ask themselves, what's going to happen if the value of my house is subject to the buyer's ability to borrow, which is going down? It's a big problem.
Finally, I want to just come back to, I think, one of the key points that you brought up in this interview today, which is that the feds are going to bail out select people, and you don't want to be left on the sidelines. So who are these people? What kinds of people are going to be?
Well, you'll see over time.
And what happens to everybody else?
You'll see over time. I mean, nobody could have predicted that they would buy junk bonds in 2020. I mean, some people did predict that SVB would fail. Nobody predicted that it would be treated the way that it was treated. It's very, very difficult to know. And I think the question comes down to who is perceived as being strategically important. And you can't answer that question because you're not in the Fed committee. I mean, there's always considerations being made as to how squeaky is that wheel. There was a congressman that asked, if his local bank in Oklahoma was having the same problem, would he get the bailout? And I mean, the obvious answer is no, because the effective pull on Washington is very low. So you've got to understand, I mean, this is a scenario where your distance from the center of power is very important, and so if you're a person that's on the outside, you don't have any sort of connection to power. And so you've got to be realistic. I mean, you can't be gambling. You can't be gambling right now, so as you watch this unfold, just realize that there's going to be selective There's going to be selective treatment. It's not a market. In a market, the failing bank has to find market support. And market support might be very low, but if it was very low, then the bank next door goes down. And then the bank next door goes down. And then people realize there's 17.5 trillion of deposits and there's a lot less actual money. Oh no, I better get my money. You see how this goes? Well, how are you going to get your money? You can only get a $100 bill. There used to be a $500 bill. So people just, the system is probably going to survive. It's probably going to survive. And so you've got to stop trying to bet on total catastrophe and realize that this is going to carry on. And the likely event is that 5 years from now, I might be a billionaire. I mean, it's not because of success. I mean, we might be having a $1,000 lunch. I mean, that's not even that good. Okay. So my point is that if you can control the rate of inflation and you can slowly over time control asset prices going up, people feel rich. You understand how this goes? A good example is with your house. If it slowly rises in value, you keep, like in Toronto, everybody feels rich because they have $1 million studio apartment. But the thing is, they kept borrowing the whole time, another 50, another 50, another 50, another 50. And the whole way up, they feel rich. And then the thing goes down just that much and they start panicking. So that's the system that we're in. And we're probably going to be in that system after this. So you gotta be positioned through that downturn. That's the type of stuff we're talking about in the Tucker letter, ebtucker.com. I really want people to come and directly hear from me because that's what I've been hearing is missing.
When's your next letter coming out, EB?
So every other Thursday at 9 a.m. comes directly to your inbox. And today when we're talking, the issue came out. 2 weeks from now, I don't bother you in between. 26 issues a year. And subscribers can see the portfolio. They can check the update at any time. But free people can also read it. David, when I was a young guy, I was hungry for learning. That's what I wanted to do, was to learn. And there were people that helped me learn in the early days. And I want people to be able to learn for free. You will hit a paywall at a certain point, but there's a lot of information that is free that people can absorb and help them on their journey. That's really important to me.
Well, let me just end on this note. I mean, first of all, thank you for educating us. There's a lot of hungry people out there yearning for knowledge watching this program, so thank you for being there for us. EB, you're telling us that the system is likely going to survive when the fear is over. Which sectors will likely do well? You mentioned banks could be an option. What else? Give us a teaser in your portfolio.
Well, banks. The thing is that banks are going to get really cheap. That's what people need to understand. And you don't want to gamble. You don't want to say, oh, it's cheap now, because you might say this bank seems cheap now, but it might get cheaper. So like in today's issue, I'm showing people the chart that I use to see if something's safe to buy or not. And the banks say no. That's what the chart says. So I don't ever want to catch the bottom of something. Like I don't want to pay the cheapest possible price, because normally if you do that, it's just luck, or you get run over by a dump truck. I mean, that's the thing that typically happens. But when this thing turns, you want to have something that you're watching. You want to have a bank that you're watching that when this turns is likely to be a large bank going forward. And so we're buying things. We're trying to make a collection of companies that make money, that have a place in the system, that are going to survive in the long run, and that are not stuck on zombie loans and businesses that have a lot of fluff that require 0% interest rates to survive. We don't own any banks right now. We're watching banks. I mean, but in the meantime, you got to have a list. You got to have a watch list of things that you want. The company we bought today, which for subscribers, I don't want to reveal the company, but is one of my favorite holdings. I bought it last year myself. I explained to people how I found the company, how I discovered it. I'm infatuated with their business. I think it's very strong. It's a business that I want to own. I'm an owner of that business, not a gambler. I'm not buying that hoping to flip it. I'm buying that business because I really like that business. I wish I owned the whole thing. And that's the type of mentality we want to have. So in the portfolio, there's room for one bank, maybe two, but it's not time yet. I mean, we haven't seen a full flush, and you want to wait for that. Even if you don't pay the lowest price, You want to wait for that because every time it goes down again, it looks cheap. It looks cheap, but it's not cheap because it might go down more. So we're waiting for that turn, and it's just not time yet.
EB, I appreciate your time today. Excellent analysis. Thank you for coming on the show. Everyone should check out ebtucker.com. I'll put a link in the description below. Thank you again, EB. I'll speak to you in a couple weeks. Thank you.
Thanks for having me.
All right, and thank you for watching. Don't forget to subscribe.